Welcome to this episode of Into the Multiverse, where we are going to talk about the advantage of having all your assets in one place. If we look at the typical investor today, they tend to have their assets in different forms. So, for example, someone might own some amount of fixed deposits. They may have a couple of bonds lying around in their demat account. They would own some stocks, some ETFs. They'll have some exposure to global investments. And this is how they've constructed their portfolio because there is a desire to have a flavor of everything, and different opportunities come to us at different points in time, making us participate in those opportunities whenever we're aware of them. This is a great way for an investor to feel like they have a well-diversified portfolio and that they're able to participate in different opportunities and that they're also able to control what they're doing with their portfolios. But it comes with a certain set of drawbacks which we need to be a little bit more aware of. So let's take a look at what these drawbacks can be. First of all, over time, it will become very difficult for an investor to measure their performance. Why is that? If you have a bank FD with one bank and you have a bond in your demat account and then you have a separate stock portfolio or a mutual fund portfolio, you're typically seeing the returns for each of these products in isolation. Then what tends to happen is you start making judgments on those portfolios. So let's say you locked into a bank FD during the COVID years, you would have earned a very low rate of interest and you'd be quite disappointed with what your bank FD has done for you. At the same time, you would have forgotten that your equity portfolio actually crashed at some point and wasn't doing really well. So when your assets are in different places, it's difficult for you to assess how they're doing together, which is actually a better metric for performance than how they're doing individually. The second drawback that an investor faces is that they won't really know where to scale up or when to scale up, right? And what do we mean by this? If we're only participating in opportunities as they come to us when they're presented, typically that means we're looking at them when there's already some level of performance. Very few DIY investors or very few investors themselves are actually paying attention to contrarian signals. They tend to look for proof and performance before making an investment decision. So when you have assets scattered all over the place, it's difficult for you to decide where to put more at the right time. What tends to happen is you put more where there is performance already, which means you've lost some of that early steam that could have come from that particular investment idea. So clearly this approach requires more dedication and preparation that the average investor is ready to put in. It also requires some level of knowledge about what's happening in the market across asset classes so that you're able to pick the right decision at the right time. So what does a multi-asset fund like Sphere do for you? A multi-asset PMS or a multi-asset mutual fund can actually simplify this decision-making framework quite significantly. First of all, it allows you to participate when you have liquidity, which basically comes down to the philosophy of investing when you have money and not thinking too much about where the market is and whether it's the right time to do a lump sum or whether you should stagger this. Because in multi-asset funds, there's always something that's worth investing in at any point in the market cycle. The second thing is it reduces the number of decisions that you have to make, which essentially means that instead of choosing between putting money in your FD or in a stock portfolio or a lump sum into your mutual fund portfolio or participating in some other kind of bond or ETF, you're just looking at adding money into one product that takes care of all of this for you. The third advantage is that it's a lot more transparent. When you have all of your assets in one place, you're able to track what you own, how much you own, and whether something is performing well or not. So this level of transparency isn't there unless the investor puts the effort into consolidating all of their investments and regularly reviewing this. So typically most asset management companies, whether in the form of a mutual fund house or a PMS, are going to send you a detailed report on a monthly basis. And the last but probably the most important advantage of having multi-asset portfolio is that it has a much lower level of volatility because not all asset classes have positive correlations. Which means in certain market contexts, some assets will perform really well, some assets may not perform, and some assets may actually be stable. Whereas in other market contexts, the ones that weren't performing and that were quite stable would actually show up in positive performance. So this means that overall, there's always one engine that's firing for an investor, and that would essentially mean that the amount of volatility that you experience, that is in terms of up and down drawdowns, will actually reduce. So these are some of the advantages of having all of your assets in one place. If you would like to know more about what Sphere does and how it can work for you, get in touch with us.